Building wealth as a teen might seem overwhelming, but with smart investment strategies, it becomes achievable. Let's focus on the habit of regular investing, which is one core strategy that can create substantial growth over time. When you start investing as a teenager, you tap into the magic of compound interest. Think of compound interest as a snowball rolling down a hill. At first, it starts small, but as it keeps rolling, it picks up more snow and gets bigger rapidly. That's how your money grows. You start by saving a small amount. The returns you earn are reinvested, earning you more returns on the returns, and this cycle continues. Over time, even small contributions can balloon into significant sums. For example, if you invest $50 a month from age 15 to 25 in a fund that averages a 7% annual return, you stop contributing but leave the money to grow until you're 65. You could have over $12,000. But if you start at 25 and invest the same amount monthly until 65, you'd only accumulate about $130,000. It shows us the advantage of starting early. Choosing where to put your money is also vital. Stocks and index funds are commonly suggested. While individual stocks can be volatile, index funds are like a basket of stocks, giving you diversity. Diversification just means you're not putting all your eggs in one basket. If one stock doesn't perform well, you have many others in the fund that can help balance the loss. It's also worth considering risk tolerance, which is basically how much uncertainty in your investments you can handle without panicking. Young investors are often told they can afford to take more risks because they have time to recover if things go badly. Investing in stocks, which can be unpredictable but have higher potential returns, might work for you. As you get older, you might shift more towards bonds, which are generally less risky but offer lower returns. There's the importance of financial literacy, knowing how to budget, understanding taxes, and figuring out how to save offers you a strong foundation. Financial literacy helps you make informed decisions and avoid common pitfalls like high-interest debt, which can erode your wealth-building efforts. Consider using available tools. Many investment accounts are specially designed for young investors. Custodial accounts, for example, allow parents to help their children invest. When you reach the age of majority, the account transfers to you, along with the investment growth. There are also apps that round up your purchases and invest the spare change. Remember that while investing comes with risk, not investing could also be risky because inflation can reduce the buying power of your money over time. So everyone, including you and me, should consider how we can put our money to work. Even if we start with small amounts, the key is to start early and keep at it. This way, we can build the financial stability and freedom we dream of for our future. Thank you for watching to the end. Kindly like, share, and subscribe for more thrilling and exciting videos.